Thank you for tuning in to Investment Insight presented by McCay Wealth Advisory. My name is Hayden Proffitt. Joining us today, we have Brent McCay. Brent, the last couple days, we've seen a little bit of volatility in the markets. Can you kind of hit on why we've seen some volatility?
Sure. So, the first thing is for investors to understand is, volatility is actually normal. We've been in a period of time from October of 23 until basically end of July of 24, where we have not seen a 5% correction. In a normal market, you see 3 5% corrections a year and 1 10% correction. And when you've not seen that correction in a while, a lot of times a correction feels more violent, it feels more unnormal because you're not used to it. When you see 5% drops all the time, they don't bother you as much.
Right.
The other part of that really matters to investors is when there hasn't been one for a while, sometimes it can get a little bit more harsh than normal. It might be a little quicker than normal just because there hasn't been one. Now, this all started, the Federal Reserve has created some uncertainty. If you look at earlier this year, we thought they were going to cut interest rates in July. They moved that back to September. They had their minutes came out on Wednesday last week, and they said, we're going to look at the data, and if inflation's really going down, if we really won, we're going to cut rates. Then when Powell talked, he said, we're probably cutting rates in September. So that caused a little bit of concern because people are like, well, wait a minute, the minutes are kind of indicating you're not going to cut. You're kind of saying you're going to cut, so what are you going to do? And anytime you see uncertainty, markets tend to drop. Anytime there's unknown, markets tend to go down. But it also creates opportunity for investors to make money. Now, when we talk about inflation, when the Federal Reserve says inflation is 1, they're not saying that you're going back to prices in 2020. What they're saying is if you're paying $17 to get a combo meal at Zaxby's, you're not paying $20 next year. You're paying 3% more. You're paying 50 cents more or something like that.
Right.
And so that is a little different because a lot of people think when they're voting and other things, they say, well, hey, you're bringing prices back to what they were. That's not what they're saying. What they're saying is we're going to stop the increase. This is the new normal.
Right.
And then we had 2 other data points that came out last week. One was manufacturing data, which came in lower, showed that manufacturing was actually contracting in the United States. And the other data point, of course, was unemployment. Unemployment, it's a very volatile number. The number's always revised. But basically, we created close to 100,000 jobs last month versus the 200,000 we have been creating in the past. And this is many people believe that maybe the Federal Reserve should have cut in July. They're waiting too long to cut rates. And maybe they should have cut last week instead of September. Good news is it's about the middle of September when they're going to meet again, when they'll probably cut rates. And we all know it's an election year this year, and politicians and the Federal Reserve do not want to go into an election in a recession.
Right.
And if they cut interest rates, you go from an 8.5% mortgage to a 6% mortgage, that's going to mean a lot of people can afford a house. You go from a 5% CD to a 2 or 3% CD, that's going to get a lot of people moving money from those CD markets into bonds, into stocks, into real estate. And that's another thing to think about. If you can get some higher CD rates locked in right now,
it's a good time to do it.
It's probably a good time to go ahead and do some of those things.
Right.
And that's the opportunity for us. We're looking at this as if it becomes a little bigger correction, this will be an opportunity. We're going to see some trade confirmations. You're going to see some rebalancing in portfolios because we want to be buyers of depressed assets, not sellers.
Right. Given all this, if you're still really concerned about the market, because the fact is nobody likes to see their portfolio in the red.
Sure.
Even if it's normal, even if it's priced in, it's one of those things, nobody really wants to pull it up and see it red. But if you're concerned, what can we do as far as going over your particular plan?
So the good thing about our team here is we've got a risk portfolio for pretty much every customer within our financial planning system through Monte Carlo analysis. So let us go over your risk portfolio with you. Let us talk about what our risk strategy is. Obviously, the bond market has done very well. We locked in some money last year at some higher interest rates, and now the rates are going down. So those assets are appreciating while the stock market assets are depreciating. And so we would love to go over that plan with you. If you give us a call at 931-728-2130 or email any of us at the office. The good thing about us is it's Brent at McCay Wealth, Hayden at McCay Wealth. And what I was trying to say there was anybody at our office, if you use McCay Wealth with their first name on it, Amy at McCay Wealth, Hayden at McCay Wealth, Genesis at McCay Wealth, Susie at McCay Wealth, that's how you can contact anybody at our office. We'd love to talk to you on the phone, in person, whatever fits your needs.
Yeah, perfect. Well, thank you for talking to us today and explaining why we're seeing a little bit of this volatility. Absolutely. And thank you for tuning in today. We hope you have a great day.
Thanks.